Rick, good to see you. So back to technology for a moment. You talk with a lot of advisors. What they will tell you is that for traditional fixed income investors, they're utilizing technology in the mega cap equities as some form of income solution. You think that's the right strategy, or does that actually present a risk for the market?
So it's a great question. There are, listen, I think part of in any environment that you have where you don't have a lot of hedges and things are correlating differently, it becomes a lot trickier. And your point is well taken. And part of how, when we think about what is our interest rate exposure, what is our financials exposure, what is our technology exposure, you've got to bring those all into the equation, which I know you do and I know you think about. It's trickier today because you hadn't been able to get any income through other mechanisms, so you had to go to other places to get them. Equity was your way to get income, and now it becomes a bit trickier in this tightening environment. So yes, that does create a bit more volatility, as you rightly said.
What part of fixed income do you like the best today for viewers who are into that?
So there are a couple of places. I mean, first of all, the securitized markets, the real estate market's in great shape. So financing commercial real estate, financing residential real estate, those are the core of where we really like the market today in fixed income. The emerging markets are starting to get pretty interesting around where local rates are. And then we're trying to keep our interest rate exposure low. The credit markets are still okay. We're going a bit higher quality in places like investment grade as opposed to last year. We did a lot more in high yield. But there's still ways to generate a positive return in fixed income. You just got to be a lot more nimble, and you have to keep your interest rate exposure pretty moderate in this environment.
High yield get any worrisome to you anytime soon, do you think?
I think that the point that is really significant around high yield, listen, I don't think the valuations are very attractive in high yield. But we're also not going to see a default cycle. If you've got nominal GDP at the levels you're at, you're not going to see a lot of defaults. And what really disrupts high yield is when you get, obviously, a movement in higher rates, but also the potential for the onset of recession and to create more defaults. Boy, I think we're far from that. And the need for yield is so big still today that it doesn't give me a lot of concern. But have I reduced a lot of it? I have, because I just don't think the valuations are that exciting anymore. I want more loans. I think the loan market is more interesting than high yield today.
Interesting. Last question, Liz Young.
Hi, Rick. So we've been conditioned that the Fed is here to save the market, right, to save us from drawdowns. I'm in the camp that this year they're okay with a little bit of a drawdown because their first priority is controlling inflation. Their second priority actually now becomes rebuilding their buffer for the next crisis, because we're 2 years out from the last market bottom. Where am I wrong, though? What would be the breaking point in the market that would make them pivot dovish again? Is it the spreads between 2s and 10s? Is it a drawdown? What is it?
It's a great question, but listen, I think the Fed is very much focused on the core economy, and I generally think people overstate the Fed's interest in the market's valuation levels. Listen, if we drew down, and there was a reason that we drew down 10 to low double-digit percent, but yes, do I think the Fed would certainly slow down this dynamic around how much they had to tighten? But I think it would have to be precipitated by, gosh, there was something in the core economy and or inflation that was causing a real concern. Because I truly believe, I don't think the Fed put is there. And I think they're really focused on how do you bring down inflation for the consumer today, and what are the mechanisms that we utilize to get there.